Richard Lyman is an author, instructor at Cal Poly and UC Berkeley. His title is A Financial Professor's Tips on Options, Trends, and Behavioral Finance. The first line of his presentation description sort of mirrors something that a lot of you are aware of. The indisputable fact is that as a group, individual investors significantly underperform the market indexes over time. He'll be going into that and also just covering the whole trends and options issue. Uh, Richard Lyman is a financial professor at Cal Poly and UC Berkeley, now in his 22nd year of teaching. Prior to that, his financial career spanned 20 plus years with Wall Street firms, the New York Stock Exchange, the wealth management division of Mechanics Bank. He took his first he took first place in a professional division of Barron's Trading Contest in 1984 and has published 2 books on options and one on behavioral finance. So, Richard, you have the forum, and thank you for presenting to us.
Thanks, Lynn. Welcome, everyone. Last time I addressed this group was back in 2023. So I took a few slides from back then, and then I added a whole bunch of new stuff. Let me pull up my slides. That should do it. We're going to take questions from Q&A, but if you happen to put them in the chat window, we can address that too. I'm going to try to pull out a couple of natural stopping points during the presentation and take a look and see if there's questions, but then I'll catch everybody up at the end if I can. This is more or less kind of a stream of thought on my part, building off of the theme that I talked about several years ago, which still holds, that there have been quite a number of studies that show demonstrably that individual investors as a group will underperform the markets. So let me kind of phrase it the way I want to walk through it, and that's that, millions of individual investors are managing their own accounts, and the general expectation is that through active trading and focused portfolios, and using tools like charts and options and their own innate stock picking skills, they assume they can outperform. Otherwise, why would anybody bother? Why would anybody spend the time and the money and the effort to manage their own account if they didn't feel they could somehow do better than just slopping their money into an index fund and walking away? But these actually are precisely the reasons why we underperform. It's the great investment conundrum, and it's been there for many, many years, and it continues. And it's not trivial. You will underperform as a group by a fairly considerable amount, and I'm actually going to give you a few numbers for perspective. Here's some headlines that appeared in various places that talk about the fact that individual investors underperform. One from MarketWatch, Seeking Alpha. I love the one from Financial Post. Says, let's face it, you suck at investing. I mean, that is the reality that's out there, and the media knows all about it. The media tends to drag it out once every year when the Dalbar study comes out, because the Dalbar study is one of the key places where they track in individual investor performance. But there are numerous other studies that verify the fact. They all have slightly different numbers, but they're all pretty much in the same ballpark. And the studies basically show that we trade too often, we have overly concentrated portfolios, which of course is, natural for smaller investors. We are hindered by behavioral and emotional biases. And this is probably the biggest mystery because most of us are not aware of that. We perform even worse when we use charts and technical analysis, and we perform terribly when we use options. And all of these factors, they correlate with poor investment performance. So in other words, the more you use them, the worse performance you're going to have. And like I say, the numbers are clear and they're pretty dramatic. Here's a quick overview. Okay, all investors, when you look at a number of different studies, somewhere between 3 and 6% a year below the market average. Okay, think about what that does to you over time in terms of underperformance. And there are a couple of studies that went a little deeper than just looking at general performance. One of them looked at people who use technical analysis. They underperformed by 8% on average. And those using options, 20%. Okay, so the tools people are naturally gravitating to try and improve their performance are actually backfiring. Okay, so the simple answer to that would be, well, why doesn't everybody just hang it up and buy an index fund or some diversified portfolio and just let it be and do a lot better? I take a different approach. My approach is individual investors could do pretty well for themselves, but they're misusing the tools. Right? So that's kind of my approach. So we clearly trade too often. We concentrate portfolios in too few stocks. We use our instincts to pick stocks, which are generally hurting us. We use technical analysis the wrong way. We also misuse options. In other words, we're just being human, right? And when you put it all together, it's really our humanness that is our failing. Okay, that doesn't mean we should all trade algorithmically. Okay, which is one answer. You could trade by computer, and that's clearly available now. From a number of different brokerage institutions, you can build algorithms. Okay, and you can let the algorithms do your trading for you. And I can't tell you because there are very few statistics available how people who do that have been faring. But I can give you one pretty dramatic example on the professional world. And that's an amazing guy named Jim Simons, passed away a couple of years ago, but he was a math prodigy and went into teaching after he did his PhD in Berkeley, by the way. Went into teaching for quite a while, then bailed out of teaching and said, I think I'm going to start my own hedge fund. Okay. Started his own hedge fund, had some difficulties in the beginning, but then went on to create Renaissance Technologies, which was probably the most profitable hedge fund of all time and still exists. He literally minted money. And what he did was he hired PhDs and other math geeks and science types. He didn't hire, finance people because he believed that the key to making money was heavy discipline and the use of computers. So the first thing that he and his hedge fund did was they went out and just got as much historic data as they could possibly feed into the computer. And they let the computer tell them where the computer saw opportunities for trading. And then they would develop algorithms and they would let the computer do the trading. So this is not a bunch of individual gunslingers, sitting at desks doing trades. This was almost entirely computerized. And they minted money. Okay. billions. He gave away most of his fortune, which was really admirable, but he gave like 6 billion to charities, upon his death. Um, one very interesting fact about Simons was he was interviewed, and there's a book about him in case you're interested. I think it's something like the man who beat Wall Street or something like that. One really interesting fact was in the interview, they asked him what his win rate was. Okay, what was the percentage of trades that were profitable versus unprofitable? And it was a really stunning figure. It was around 54% to 46%. Not 90%, not 80%, 54. Okay, that's pretty much along the lines of the numbers that a casino has. The casino adds a vig, and the casino wins about 54% of the time versus 46, and they can mint money as a result because they continually use that money over and over and over again. Same thing with Simons. He minted money with a 54% win advantage, which I think was really quite telling. But coming back to the main point here, it wasn't a bunch of individuals with instincts about trading. It was computers who could look totally objectively at the numbers, at the historic relationships, the trends, the profitability numbers, and put together algorithms that would trade profitably. And then, many times they would work for a while, then stop working, and they'd use different ones, and they were constantly looking for new ones. They played all markets, not just equities. So really interesting guy, and I think there's some great lessons there about how there really is no such thing as having a really good instinct for trading. We may think there is. We may envision sort of the Hollywood version of a trading room with a bunch of people sitting at desks, who are, really smart, really intuitive people, just doing trades. That's not what trading's all about in the professional world. It's much more like what Simons did. If you're at a hedge fund, that's most likely what you're going to do is you're going to sit in front of a computer. You're going to program the computer to look for certain things, and you're going to let the computer actually do the trading. That's how the pros make money. So in a sense, they're making money off our mistakes, right? So the bottom line is that our humanness is really one of our biggest enemies in terms of success in trading. It's more or less an inconvenient truth, but human behavior is the direct result of evolutionary influences, and investing was never a critical human survival skill. Okay. And behaviorists argue that there really is no such skill that by mere intuition, somebody can have the ability to pick stocks on a consistent basis and make money. Now and then, sure, you're going to hit it. You're going to get it lucky. But on a consistent basis, doesn't exist, right? So the pros are human, but they're better, and they're better because of the reasons I just explained. It's because they're using computers. They're taking the humanness out of the equation, and they're strictly playing the numbers. They also hold large numbers of stocks. If you're talking about pension managers, institutional managers, why do they hold up with market returns? Because they buy the market. They're not trying to pick the best things. Now you get a different situation with somebody like Warren Buffett. Warren Buffett was very unique. And the reason Warren Buffett made so much money was he bought whole companies. Okay, very different than buying and trading stocks. And we could go into that but it's a whole lot of different reasons. So the way I organized uh, my talk this morning is to offer some tools and tips for individual investors on how to overcome that deficit, how to reduce that, 3 to 6% average underperformance every year. Um, Part one is really understanding behavioral finance and your behavior. Uh, Part two, I want to address using TA. I do believe TA has merit. Unfortunately, most people will misuse it. Uh, the same thing with options. Um, I, I'm a tried and true die-in-the-wall options trader, and I've been using options since day one. I wrote 2 books on it. I teach it. And I think everybody who does anything in the equity world should know some basic option strategies. But again, people grossly misuse it. And part four, I'm going to give you a little bit of my approach and how I manage my money, which, isn't going to be for everybody, but it might just give you, some ideas. So in terms of behavioral finance, it's really, really important to take that subject seriously. Our behavior is our worst enemy. Our instincts are our worst enemy because our instincts were not developed for this end result. Okay, they weren't developed for stock picking. They were developed for survival, which is an entirely different set of skills. So I strongly recommend that you pick up at least one book on behavioral finance, immerse yourself in it, get a sense of what it's all about. Even better, take a course in it. There really aren't that many available, but my Berkeley course actually is open to the public. Um, and appreciate it. Appreciate it for what it's worth because your behavior is what's holding you back. Your mind and your instincts, which you would like to believe have been well honed, are what's holding you back. It's what's causing that 3 to 6% underperformance or worse. Once you learn a little bit about behavioral finance in general, and what it means and all the biases and heuristics that people use in everyday life and in trading, you then need to focus on yourself. Okay, it's one thing to learn about behavioral finance. Just learning about it isn't going to make you a better trader by itself. Taking that and learning about yourself is the next big step in the process. If you understand yourself well, and you understand your limitations, and you understand your strengths, and you understand your risk tolerance and your comfort levels and knowledge levels with different investment approaches, I think that's going to make the single biggest improvement to your performance that you can make. A couple of points along that line, and I mean, I could give you 50 points, but I kind of culled it back. Remember, I teach a whole course on it at Berkeley, and it's 10 weeks of 3 hours sessions. We go through about 25 major behavioral biases and heuristics. And then we talk about how that affects markets and everything else. It's a subject, that is pretty involved, but there's a few things that I can sort of tease you with. One is the old poker adage, play the players, not the cards. I think that applies in stock trading. You are essentially playing a game against millions of other players. play them accordingly. If you don't understand what they're doing, don't play. I just had a situation. I was using U.S. Treasury bonds, the TLT ETF, to do some trading, primarily when I didn't have stocks I was really excited about, and I just wanted something, keep my money working. Instead of sitting in T-bills, I would sit in TLT, and I would write calls on the TLT. Um, but strange things started to happen in the market for US Treasuries. And the more I read, the more I got the impression that things were happening I was never going to be aware of. Things at the Fed, um, things with the international geopolitical situation where other countries were buying or selling Treasury bonds. And they were moving in ways that befuddled me. And so the first thing I did was I just stopped. Okay. If there's a market you don't understand, and that means maybe only at a particular point in time, uh, don't trade it. Okay. Um, you may think, that it's kind of simple to think of stock trading and the stock market as a game, but game theory is actually a big part of what goes into understanding how to play the markets. You can go all the way back to the beginnings of game theory, which were over a century ago. Yes, they apply to poker. Yes, they apply to chess. They also apply to the markets. Um, Next one, expect under and over reactions. One of the big conclusions you'll reach when you understand more about behavioral finance is to not only look inside at yourself and understand what makes you tick, but you can understand a lot better what makes markets tick. Okay, it's not going to give you perfect knowledge by any stretch. Okay, but it does give you insights. One of the insights you can take away from behavioral finance at the market level is that the market tends to under and overreact on a relatively continuous basis because it's people. Okay. Um, it's people full of FOMO, fear of missing out. It's people with loss aversion, fear of losing money, and all of the other, behavioral biases that are common. As a group, it's very easy to see that play out in the broader market. Um, and under and overreactions uh, can provide, I think, some really interesting insights to trading. Under and overreactions usually revolve around some kind of news, clearly around earnings announcements. When you get tons of people who want to make their bets about whether earnings are going to be good or bad. And those reactions come pretty regularly. You can always find them because there's always news and there's always earnings reports come and due and that sort of thing. Once you get a feel for how markets under and overreact, it will surface a lot of interesting trading opportunities. And I put down this statement to think about. Reactions to big moves are actually easier to predict than the big moves occurring in the first place. If you're dealing with a stock that hasn't had a super big move and you're expecting something like a new technology development, a new product, competitive advantage, earnings statement, partnership with another big company, whatever it is that you're expecting, lots of people will look at those things and make their bets on those anticipated events. that's really dicey. I think that's a really easy way to lose money because it's really, really tough to predict those. Okay. On the other hand, if you wait until an event occurs and you just look around for where stocks have made big moves, the idea that they will then react to those big moves, both under and over, um, becomes, in my estimation, a much easier play. So when you get an earnings announcement that's maybe a little bit or a lot under expectation and a stock plummets, there's a pretty good chance, that once that plays out, which is usually pretty quick, sometimes same day, it will bounce back. And I find that to be a more predictable way to play big moves than to try to predict when there's going to be a big move to begin with. So just one little tip there. To go into a couple of the big biases, and like I said, there were about 25 that we study in my course, but boils down to about 5 or 6 that are really key. Unconscious herding is one of them. Okay, unconscious herding will tempt you to go into markets simply because you see things moving in one direction or the other. It's the concept behind FOMO. And unfortunately, one of the biggest problems with herding comes from the media. The media is telling you what happened yesterday, okay? It's not telling you what's going to happen tomorrow. And on top of that, media has now become more biased than you want to know. Okay, I am really sour on the general media. I used to read the Wall Street Journal and thought it was like the Bible. Okay, it's no longer, and you have to clearly stay away from the opinions in the Wall Street Journal. They are totally biased. Okay, getting biased information is not helping you. The media, which unfortunately is where we get a lot of our information, is really in the business of capturing eyeballs, selling advertising, selling subscriptions. They're not in the business of making you money. They're not in the business of giving you timely and meaningful information. That is not their imperative. They want to give you something that attracts your eyes and enables them to make money via subscriptions and advertising. I'll give you a little example of something that happened to me. I used to write for Seeking Alpha, and there's an editor at Seeking Alpha that I knew, and she knew me because of my writing. She then left Seeking Alpha and went to Fortune. And so she called me up and she said, "Do you want to write an article for Fortune?" And I said, "Okay, sure. What's the deal?" She said, "I want you to write an article on, top 10 stocks right now." And I thought, well, okay, it's a little bit of a challenge. How about I give it back to you in a week or two? She goes, "No, I want it tomorrow." I said, "Well, how am I going to do all that analysis and come up with my best 10 stocks by tomorrow?" And she kind of laughed. Okay. She had no intention of my doing any analysis, right? She just wanted me to pick 10 stocks. Okay. This is how the media works, people, right? They are just feeding you what they think you want to hear and making it sound legit because they're Fortune or they're with Wall Street Journal or Barron's or whoever they are. It doesn't mean that there aren't going to be nuggets of really good stuff in the media, but now I think the information we get from the media on the whole is actually more detrimental than it is helpful. There are innumerable really good newsletters, Substack letters, subscription services by professionals who who make their living by giving you good information, not junk, right? Um, those are the ones you need to follow, and you don't need to follow that many. Um, so I think it's really important to for our own behavior to get rid of a lot of the bad influences on our behavior, many of which come internally from ourselves, but many of which are now also coming from reading biased information or old information, or information that was just, slapped in there because they thought that's what we'd want to read. So find a good newsletter, pay a little bit of money, subscribe to something you can rely on that gives you good information, um, and use that. I do like Seeking Alpha. I think it's got some advantages in that the writers are mostly analysts, they're investors themselves, they're industry experts in many situations, and most of them have skin in the game. Okay. Um, and they're only as good as, their own track record. Once they start writing and making bogus commentary, they won't get seen anymore, and they tend to filter out. So the ones that are there are pretty good. And then you also have the advantage of being able to see, maybe half a dozen or more different opinions at once. So, um, I think that's one good source. It's not that there aren't others, but I put in a couple of good words for Seeking Alpha. All right, another strong bias is confirmation bias, where we get a premise in our minds and we look for information on it, but we are biased towards looking for information that confirms our existing opinion. Okay, let me find somebody else who agrees with me that this stock's going to go up because of X, right? You should do actually the opposite, right? We should seek out information that disagrees, because the only way you're going to be objective is if you hear the other side of the arguments. You will get that in Seeking Alpha. And a lesson that I take is from the Supreme Court. I don't know if you are aware, but on every decision the Supreme Court makes, they require that a member of the bench writes a dissenting opinion, and it goes in the record. So no matter what the vote is, whether it's 5-4, 10-0, whatever the numbers happen to be, somebody always has a dissenting opinion, and they require that it be put down in writing and that everybody read it. I think that's a really telling statement. I think it's brilliant that they do that. We should do that. If you really like a stock, and this is especially true in situations where you're head over heels for something and you're going to be putting an over allocation into it, as a result, find a dissenting opinion. Find somebody who doesn't agree with you. Find out why they don't agree with you. Chances are you're going to learn something interesting you didn't know before, because you tend not to seek those things out on your own. Next is loss aversion. Very powerful emotion. And by the way, all these behavioral biases and emotions are all in our subconscious. Okay, so don't think that, oh, yeah, okay, I now know loss aversion is a thing and confirmation bias is a thing, and and herding is a thing, and I'll just avoid doing that the next time. It's nowhere near as simple as that. It's going to take some real work, and in many cases, what I've ended up doing is not changing my own emotions, but working around them, circumventing them so I don't make those kinds of mistakes. So loss aversion is another powerful one. It causes us to sell winners too quickly, grab a little bit of profit, and hold losers too long. So if you're planning on holding a loser, and you're convincing yourself that, well, I'll just sell it when it gets back to even, which is the typical way that loss aversion ends up manifesting, you're probably fooling yourself. My answer to that is, if you have a situation where you have a loser and you've just decided, well, I'm not selling it at a loss, I'll just wait till it circles back. As soon as you say that, prompt yourself to ask yourself another question. And the second question is, if I didn't own this now, would I buy it here? And if your answer is heck no, then you shouldn't hold it there either. Okay. Generally, you're adding more risk by holding on to a loser than you think. Another one is endowment bias. You can sum that one up by saying once you own something, you can no longer be objective about it. Okay. People who own homes, people who own businesses always want more money for that than the market wants to give them. Okay. Just a fact. Same thing with stocks. Right? Once you own a stock, you will no longer be totally objective about it. If you need to be objective, ask somebody who you know, and getting a trading buddy is actually a pretty good idea. Ask somebody who doesn't own that stock and get their opinion. You shouldn't think about marrying your stocks. You really just should think about dating them for a while and playing the field. Otherwise, you stay in stocks way too long, especially the losers. All right, so I'm going to go into part two, but let me see if there's any question. Okay, so Mike says the Supreme Court is more biased than ever. Yes, that's true. But the fact that somebody writes the dissenting opinion, and we don't generally see the dissenting opinion. So we see the biased opinion, but they do write up a dissenting opinion. And I think that makes for a super habit that we should adopt to find somebody, or even to develop ourselves, an argument counter to what we are about to do, to see just a sanity check, to see if it makes sense.
There's a number of questions in Q&A. Do you want to look at them, or do you want me to read them to you?
All right, you want to go ahead and read a few?
Okay, the first one is, what is it that using technical analysis do worse?
Well, why don't we hold that question, because I'm just about to go into the technical analysis part.
Okay.
That may get answered.
Forget the market. A balanced portfolio will always underperform the market. How about comparing to a 60-40 portfolio as a benchmark? Or how do individual investors do versus a 60-40?
I haven't seen specific figures that differentiate between 100% stocks and a 60-40. 60-40s come under a lot of scrutiny, and even the classic people who swore by 60-40, which really was pension funds and those kinds of institutions, even they're getting away from 60-40. So I don't think 60-40 ever was so much a real mathematical advantage, other than just a good guideline to say that you ought to have some, something counter to your aggressive equities in your portfolio, whether that's bonds or just less aggressive equities, maybe utilities or ETFs or things like that. I think 60-40 is just almost senseless. It was a rough, broad guideline. And in any of the courses I teach, there's nowhere that says 60-40 really should be a rule, because that's been the best performance, over any long period of time.
What behavioral finance book would you recommend?
That's a great question, because there are many. At the end of the slide deck, I have a slide with about 6 or 7 different books. So I will mention them at that point.
Okay. Can you please suggest a few Substack and newsletters to follow? Highly recommended.
Uh, I don't feel like I'm an expert because I don't feel like I have a really broad sense and I haven't tried a lot of them. I use I use very few. I mean, I subscribe to Seeking Alpha. I subscribe to a guy named Larry McMillan. Larry McMillan, I have followed for decades. I used to work with him in the business early on. He's an option guy. So if you're doing anything in options, I think Larry McMillan he wrote the Bible on options. He wrote the biggest, most used book on Wall Street, Options as a Strategic Investment. And he has, and for many years, he has a service. He has Substack letter. If you're doing anything in options, I'd say use Larry. But beyond that, I hesitate because I don't want to pick from what could be hundreds of really good ones and isolate out on any particular one because I don't use that many.
How do contrarians compare to those who are following the herding? Is contrarian advantageous to counter the bias that follow the irrational exuberance of the media?
Uh, I would say yes. I say it's good to have a little bit of contrarianism because when I talked about under over reactions, that incorporates contrarianism. Um, I will not hesitate if I see a stock go vertical after let's say a big earnings jump or, nowadays like a big capex or a big partnership agreement. But as soon as I see that top out, I start playing them short just for the reaction. I think contrarianism is healthy. I think it helps you do what I just described in terms of, taking the dissenting opinion. Um, and that it's a great mental practice to adopt. Take the opposite opinion and see if it makes sense to you. And if the opposite opinion makes sense to you, then maybe you ought to rethink the opinion, you really had in the first place.
Could selling a loser be a plus for tax loss harvesting use and reduce income tax owed? I do not prefer to have the tax tail wag the investment dog, but thought I would ask regardless.
Well, I think, in taxable accounts, tax has to be a consideration. It's part of your return. Okay. People that don't consider the tax usually end up getting stung by it. It's a common practice now to sell losers in order to offset winning gains so that you can get out of both positions and take on new positions. And I think that's a reasonable strategy, the tax loss harvesting approach. Lots of advisors are doing that. But the key thing is more important than the tax is whether or not you're actually taking more risk by holding something that's a loser. All right, let me move on to TA, and then we can catch some more questions at the end. How's that?
Okay, there's also one person with a hand up that we can deal with then.
Okay. All right. So technical analysis. I want to mention I have been a TA fan since the very beginning of my career. I used to get that big blue book with all the charts in it once a week. And when they became electronic, it was like, whoopee, I get real-time charts. That was just phenomenal. So I truly believe that technical analysis can give you context you can't get otherwise, right? However, the field of TA consists of many, many different approaches. It's not consistent. And even within a particular approach, many people do it different ways. And therein lies the problem. There's a lot of what I consider just bogus things that get incorporated into TA. You know, in the history of TA, at one point, astrology played a big part. People were making bets on stocks depending on where the planets were. Okay, that was part of TA. There's still a lot of, what some people call voodoo in TA. I still think it's there, but I think there are nuggets of TA that are very important for understanding some context on a particular stock. So while I'm a TA diehard, I am a very specific TA diehard, and that is to use a very limited number of things and not to get waylaid by lots of other things. One of the problems when we look at a chart is that the human brain is programmed to see patterns and to look to complete patterns where you see particular trends, like in a chart. Okay, that's not good, because the way our brain works isn't the way stocks work. So you give a chart to anybody and say, where do you think this is going? They'll have an opinion. Okay, but it's going to be bogus. So I think there's a few key things. Moving averages are healthy. Trend analysis can be healthy, but lots of people do that weirdly too, and make up their own rules as they go along. I use a very, very specific methodology on my charts that I develop myself, that I'm happy with, that makes sense for me. And I avoid all the rest of it, particularly when I'm reading something and somebody says, from a technical standpoint, this looks really good. Because I have no idea what that means. Whether somebody just looked at it and decided, gee, it looks like it's going to curl up, or what. Don't trust anybody else's TA. And if you're going to trust yourself to use charts, identify some very specific kinds of techniques and rely on those, and don't be distracted by a lot of other BS. I believe stocks trend. I believe the market trends. And I did some analysis in my behavioral book, because the behavioral book tied in with technical analysis. And I did a study on my own of 3 years just prior to 2008, 2005, 6, and 7. 3 very different years in terms of performance. And I did some trend analysis on that. And then I gave it to a student at Berkeley in the statistics department. And I said, hey, tell me if this is statistically relevant. And he came back and he said, yeah, it's 98% statistically relevant. So I am a firm believer that the market as a whole trends and will stay in trend and will hit the tops and bottoms of trends on its way. That doesn't mean it gives you exact buy and sell points very often, but it gives you some good context for what the market is doing. But it starts to degrade really quickly when you get into individual stocks, because there's all kinds of games being played in individual stocks. They are not moving in accordance with where the market is sending them. Okay, they're moving in all kinds of different directions. So I do really believe in trend analysis. I've developed my own, and I use that pretty much exclusively as my chart technique. And I'll look a little bit at moving averages. Beyond that, I don't get caught up in trying to develop, patterns of, cups and handles, and, 3 peaks and a trough and bull flags and bear flags. I avoid all of that, because I think it's very low probability stuff. but I do believe in the trends. I also believe very strongly in the sinusoidal patterns of stocks and of the market. Okay, everything trades in a sine wave over time. It's not a regular sine wave. It's not uh, a sine wave you can easily predict, but it is a sine wave. Everything moves according to that. The longer chart you look at it, any stock, some of them are going to have real long upward movements, but eventually, they roll over and they have counter movements. So you got to be careful because the human mind does tend to complete patterns, and it doesn't do it in a way that you can count reliably on. So if you are just eyeballing a chart and you're not drawing any lines or looking at any specific points or applying any math to it, you're just grasping for straws. Okay. So I watch very closely the SPY, the Qs, and the IWM because at a market level, that gives me really good indicator as to where the market's going and what it's doing and what it's reacting to. And inside of that, then I will pick stocks accordingly. But you got to avoid doing something like just picking up a chart and drawing some willy-nilly lines and saying, oh, look what I found. This line ended up over here. And if you're making stuff up, forget it. Okay. Totally unscientific. Right. So again, in my book, I tied TA to behavior because once I learned about behavior, I recognized that there's things there's insights on the way the market moves that relate back to human behavior, and it's human behavior that drives the markets. Okay, and so that's how I developed my own trend technique and using that for context. It's not a be all end all, and it doesn't give me points at which I bet the farm, and but it gives me an edge. I think the charts can give you a context that you absolutely can't get from fundamentals. Okay, use them to gain context. Use them to give you a sense of what's going on, and the charts may give you a sense that gee, I thought the fundamentals of this stock are good, but the chart's telling me it's not necessarily going up. And I can't justify those two things, then just don't play the stock. Okay. If one disagrees with the other, that's the first clue that something's going on you don't know about. Right. Another tip is to look both at short-term and long-term charts. The more data you look at, the better. There's a statistical number that I always keep in my mind when you're looking at data points like price history, and you're looking at a history of them and you want to project them forward, which is what you want to do with a chart, right? Then you should have upwards of at least 200 data points to get a 90% plus confidence in your projection. That's just pure statistics. Right. So if you're looking at, a week or two, you're not getting the full picture. So I look at both short-term and long-term charts. I look at 15-minute charts over several weeks, and then I look at daily charts over a year plus. And they both have to agree. If I get disagreement, I'll tend to avoid making any kind of a bet based on that. All right, so part 3, options. Okay, options were, if you recall the statistic at the beginning of this presentation, one of the big things that craters performance. Okay, yet I firmly believe options can be an advantage. They're just entirely misused. Right? Most of what individual players will use options for are to buy long calls and long puts. Okay. The worst strategy in options. Right? Once in a great while, you might make a play on a long put or a long call that makes sense, that gives you the leverage you need with a limited loss. But as a regular strategy, paying premium for time is the worst strategy in options. The pros take the other side of all the individual trades that the investors make, because they are the ones that are writing those calls and those puts. They make money. The people buying them, yeah, now and then you'll make a hit. Consistently, forget it. I gave a talk at a big conference of the CMT Association. It's the Technical Analysis Association. And after my talk, which was on similar subjects here, a guy came up to me and he said he was a VP at one of the online discount firms. I think it was Ameritrade. And he told me, he said, you were spot on options. He said, we figure that an options trader will burn themselves out in 6 to 9 months. And so we have to keep recruiting new option traders. We have to keep getting new clients, because the ones that come in and start it don't last very long. Okay, the industry knows that individuals are terrible at playing options, and buying options is the worst strategy. Okay, you're paying time premium for the privilege of sitting around waiting for something to happen. Okay, that's a bad bet. And when the volatility is high, meaning the option is very rich, very expensive, you're paying even more. Right? So never, ever make a bet on earnings, for example, by buying a long call or a long put, because the only way to make money on those is to sell them, not buy them. And so the professionals know that. So there are professional hedge funds that just do options, and there are lots of institutions, including even pension funds and conservative outfits, who write calls on their stocks. They're the ones who are enhancing the returns and making money, and they're making it off the mistakes made by individual investors. The truth about options is, options really are the single most versatile investment tool in existence, bar none. I teach derivatives. Nothing else comes close to giving you the flexibility and versatility of options. Everybody who does equities ought to have at least a basic understanding of options, even if they don't trade them, and should look at call writing to enhance their returns. Let me tell you, there's nothing more pleasurable than writing calls and making money between Friday and Monday while nobody's doing anything else but mowing their lawns. Okay, you get paid for time. Wonderful concept. You don't need a 60-40 portfolio. Just write calls on your stocks. It's like owning bonds. You're adding income to your stocks. It's a wonderful strategy if done right. Right? It also gives you a lot of latitude to make mistakes. It also gives you a hedge. And the versatility of options between call writing, between spreads and other types of things, gives you the ability to fine-tune a strategy for any stock scenario you can come up with. Options can reduce volatility in a portfolio. They can generate income. They can protect downside. They can provide leverage. They can help diversify. They can manage your taxable gains if you want to move a gain into the next year or something like that. They can make money in either direction. It's intensely more versatile than just buying stock, which is plain old binary. It's either you're long or you're short, and very few people will go short. So it's usually you're long or you're long something else, or you're in cash. Okay. I can't imagine being an equity investor without having some appreciation for options. Now, that said, many people use it the wrong way. Okay. And the worst long way is just buying long calls and long puts. Buying a put to protect stock is is a senseless strategy. You're paying a bunch of extra insurance money when you could be taking in money instead. Much better to write calls, write it in the money call if you really feel the stock is going down. I think a lot of people don't have the right kind of mentality to do options, and I don't recommend that everybody do them. Okay, you have to appreciate them. You have to think in certain ways. You have to be able to think in both directions. You have to be able to think in terms of time and volatility. But if you do, I think they're the best tool out there. My line down at the bottom there says there's an option strategy for that. There is. You tell me what you think a stock's going to do, and I'll give you an option strategy for that. Okay. Whereas if you think a stock's going to do something and you don't use options, you have two choices. You're going to be long, or you're going to be short, or you're just not going to play. Okay. Why limit yourself to only those choices when there's a ton of things you could do in a much more nuanced way to improve your performance on that particular equity? So I think everybody who does equities should have some appreciation for options, even if you only use options to give you extra information and don't trade them. It's kind of like the futures markets. The futures markets are known to offer price discovery on commodities. All right, price discovery meaning the market's going to tell you what it thinks this commodity is going to sell for in the future. Well, options give you that same clue. That can be very helpful. I think everybody who does equities, at the very least, should explore and understand just basic covered call writing. Okay, it does not add risk. It subtracts risk from your portfolio. It makes your portfolio less volatile, week to week, month to month. The idea of bringing in income, regardless of what the stock does, is a very, very comforting process, and it really helps. It helped me. Okay, it may not help everybody, but that's the way I invest, and I wouldn't invest otherwise. I wouldn't feel comfortable just being in a big portfolio of stocks with the amount of volatility I would get week to week and month to month. I wouldn't be able to sleep nights. So that's me, right? So by covered call writing, I smooth that out. Okay. And in theory, covered call writing should, if options are priced fairly, give you the same long-term returns. And I did a study on that in my book as well. The same long-term returns as holding stocks, but much less volatility month to month. So I feel pretty strongly about it. My books are still out there. Well, the second one really is obviates the first one. So the second one was an update. The second one was options for volatile markets. You may be looking at that backwards, but you should be able to get a hold of that. An easy, simple book. And it basically talks about covered call writing, the benefits of it and what it can do for you. It doesn't go into lots of exotic strategies. It was really meant for just everyday people who are otherwise equity holders. Okay, let me just bring you, the fourth section here is kind of quick. I see we're at 10:06, so we got about 15 minutes. Let me do this and then we can take whatever other questions there are. Part four is my approach, just for sakes, just for, okay, how does a finance professor manage his money, right? What does he do? My approach is based on very short-term insights and short-term strategies. I basically look at a 1 week time horizon. Okay, I look at, can I make money at the end of this week? And how would I do that? Now, remember that I'm writing a lot of options. So I'm looking at options that expire on Friday, and I don't have to go any further than that. I say, what could I buy on Monday and write a call on and have a pretty good degree of confidence that I can make money by Friday when the option expires. And if I get called away, so be it. Fine. I'm not afraid of short-term returns. If you're in a taxable account, you may want to adjust that strategy. But for me, I don't mind. And I find that, number one, I pick much different stocks. If I had to pick a stock that could go up 10 or 20% over the next few months, I'd be looking at a totally different list. Okay. What I'm looking at is a stock that I have a pretty good degree of confidence in, and a call that has hopefully a little overvalue to it, because that gives me an extra edge. And you can see calls that have excess value by looking at volatility and Black-Scholes, and those numbers are usually available. So if options are overpriced, writing consistently overpriced options should give you an edge. If options are fairly priced, then covered call writing should give you the same basic return as you would just holding the stock by itself. Right? Either way, you're going to get much lower volatility. But the advantage of my 1 week time horizon is, again, for me, I can come up with all kinds of ideas where, hey, I can buy this stock, I can write a Friday call, and I can make 1 or 2%. And so most people say, so what good does that do you? Well, if I could do that every week, I'd be doing pretty darn well. I'm not going to do it every week. It's not going to work every single time. But let's say it works half the time. Okay, I'm on track for a 50% annual return, and I'm compounding every week, because option premium I take in 1 week builds my portfolio a little bit. I got a little bit more that I can use the following week, et cetera, et cetera. This is the way I manage my money. Okay, I can't even conceive of trying to pick stocks that are going to go up 10 or 20% in the next few months. I just don't have that ability. First of all, I've never followed fundamentals enough to do that. I've always been more of a technical person. And if you're technical, you're by definition short term. So I do this. If at the end of the week I get something that looks pretty good, I'll roll the option out another week. If it gets called away, fine, it gets called away. If I'm ever called away, it's because I made money. So that doesn't bother me. And I'll use different stocks. I'll take a stock that I don't have a lot of confidence in over the next few months, but that I do have a fair amount of confidence in for the foreseeable, 5 days, right? And now there's also options that expire not every day, but 3 times a week. So you can buy SPY or Qs and write Monday, Wednesday, Friday. I can write 3 days a week on TLT, Treasury bonds. Okay. That's usually my safety valve, although some wacky things going on in the TLT market. So I'm doing them less than I used to. And that's it. I get most of my return from the option premium. That's fine with me. It's more reliable. It pays me for time. And I'm not sitting there, going nuts for when's the news going to come out? When is the stock going to go up? That doesn't say that I don't have a few things that I just buy and tuck away. I do. I happen to be strong, strong feeling about the quantum stocks. So I got a couple of quantum stocks. Yes, I put them in there and I tuck them away. By the way, you can write on those. And I can write way out of the money and still get premium on those because they're so volatile. But that's something that I intend to hold for a while. Um, so that's it's a fairly simple strategy, and I don't admit that that strategy is for everybody, but I think there may be something you can take away from it, which is the idea that if I looked 1 week at a time, would I buy different things than I'm looking at for the next several months, okay, or several years, right? And I think that additional perspective, can help you come up with some ideas you wouldn't have come up with before. And there are some situations where I just want to make money off the option premium. I just need to know the stock won't go down. I don't care if it goes up 1%, 10%, or stays flat for the next week. I will still collect my option premium. And the option premium pays me for a week's worth of time. And options, if you play them really short term and over and over and over again, you get a lot more premium than if you play one that's 3 months out or 2 months out. Just play every week. Play and I mean, for a while I was buying SPY and just writing every other day. Roll them if I have to. But again, that's just me. I'm a dyed-in-the-wool option player, and I'm more comfortable with a low volatility portfolio where I just hit singles all year long. Okay, so here's the slide with some books, just a few samples. Predictably Irrational from Dan Ariely, a couple from Dan Crosby that are a little more recent, and Dan Crosby is immersed in the financial business. He's a chief behavioral officer for Orion Securities. Dan's good, and he's more current. Thinking Fast and Slow is, the old original Dan Kahneman book that just talks about behavioral science, not so much about markets. Finance for Normal People was supposed to be actually a textbook. Meyer Statman teaches at Santa Clara. Michael Lewis, that's really more of the story of behavioral finance, not so much what behavioral finance says. Psychology of Money by Morgan Housel is very popular, and that's been fairly recent. And one that I really loved was Subliminal by Leonard Blodno, who's a physicist, actually, worked with Stephen Hawking. Wonderful set of entertaining examples about how our unconscious mind rules our behavior. A delightful read. And there's more, and I can certainly provide more, in some way. Maybe I can put together a list, and it can be posted along with this. I'll talk to the authorities on that. Okay, let's take some questions.
What about using Value Line for detailed information as well as their analysts' recommendation in general on the market and individual stocks?
I think Value Line is good, but my opinion on Value Line goes way back because I haven't used it in decades. I used to know a guy that worked there, and when I was in the industry, I used it. I just haven't used it more recently. I imagine it's pretty good.
What are your considerations for earning dates while writing calls?
Earnings announcements create an exceptionally large amount of betting in both directions on stocks. Okay. That that sends the options into the stratosphere in price. I played uh, a couple in the last 2 weeks. Okay. One was First Solar. Okay. I love the stock, low PE in a business that's only going to grow despite the administration trying to cut down on, on climate stuff. Premier solar company in the US. Um, and they were coming out with earnings. Okay. It tends to be a little bit of a volatile stock. The options were 2 to 3 times what they normally should go for, given the stock's volatility. It was irresistible to me not to write them. Okay. Um, the stock was moving up before earnings, and then the day of earnings, it actually moved down and spooked me a little bit. But once the earnings came out, it tore. It went up like 20 points, right? Um, but I got so much option premium. I was such a happy camper just to take all that option premium in because if it didn't soar, I was still going to make money from all that excess option premium. Um, so, earnings, buying a call or a put into earnings is a terrible strategy because the volatility comes out as soon as the earnings are announced. The stock will do what it's going to do, but you're going to definitely lose money on a long call or a put, and yet people still make those bets. Much better to write into earnings with covered calls, and occasionally, if earnings surprise on the downside, you'll lose some on the stock, but generally you can make up most of that loss with the call premium.
Given your weekly call writing compounding model, can you comment on the role and value of selling cash secured puts also?
Good question. Cash secured puts are the exact same strategy as writing covered calls. Okay. From a P&L standpoint, it's exactly the same risk reward profile. The only difference is instead of owning the stock, you only have to put up the collateral for a cash secured put, which is about 20%, give or take, of the value of the stock. So cash secured puts actually give you more leverage than covered call writing for the exact same risk. So for people who understand that, cash secured puts are an excellent strategy.
Do you have any comments on Scott Judd's Sector Surfer or Tom Gardner Motley Fool?
Um, no, I mean, Motley Fool would be the only one I might have an opinion on. And it's not a terribly high one from my looking at it. I don't like the fact that they're sensational, that they put out ads about, here's a 10 bagger, here's our next stock that was like buying Nvidia at 16 cents. I mean, it's ridiculously over marketed. Um, inside of the service, it may be better, but their advertising turns me off completely because they make such sensationalistic claims, and I think that's totally misleading. Um, that said, there's a kind of a Seeking Alpha type flavor to it, and for some of the reasons I like Seeking Alpha, Motley Fool probably provides some of those same advantages.
Uh, Jack Glacier had a question. He had his hand up. I'll let him talk and then we'll have to end for questions.
Okay.
Are you there?
Yes, but I don't remember which question you're referring to.
Initially, you had posted about technical analysis. I don't know if your question was answered.
Hmm. Was the question was what makes it people who use technical analysis do worse than the thing before it? I couldn't remember. Uh, uh, Yeah. I mean, why do they do worse? He may have answered it in a way.
Yeah. Well,
I'm not sure.
I'm
Yeah.
happy to go over it.
Yeah.
What it is people misuse it. People don't realize that the human brain tends to find patterns where they don't
Okay.
exist.
Yeah.
Okay, so people will use a chart, but in the wrong ways. They'll
Right.
just eyeball the chart and say, "Oh, that looks like it's going up, or that looks like it's going
Mm.
down," which is totally
Right.
unscientific. Okay, and usually steers you wrong. Right. So um, that and pattern recognition, like some of the patterns that they call out, I think are the worst parts of technical analysis. But things like moving average or MACD, moving average convergence, divergence, and trend analysis, if done right, um, could be really helpful.
So MACD and relative, how would you use relative strength then? And MACD?
Uh, well, relative strength and MACD are doing, similar kinds of things. They're giving you a perspective on a stock's price relative to some other benchmark, like its own history or the market. Okay. And I do follow, there's one other guy that I follow. His name is Michael Gayed, Gayed. Um, he has an interesting methodology where he looks at sectors, not so much individual stocks. And he talks about how those sectors are performing and where institutional money tends to be rotating into one sector or the other. Um, and I do follow that kind of analysis. He's got a free Substack plus his subscription. It's called the Lead Lag Report. Okay, so we out of time?
Yeah, we'll take a quick break and start the second presenter at 10:30.
Okay, I'm going to put up my email here in case anybody wants to follow up, get a list of books, or has some questions because I know I went through the stuff kind of quick. Happy to take an email and respond to people.
And I'll try to send you an email of the pending questions that we don't have time for.
Okay, great. Thanks, everyone. Nice to be here.
Thank you. There's also a number of compliments on your presentation.
Thank you.